Okay, welcome back. There's 2 minutes to go for the pre-open session, but I must say that we are one dedicated bunch, right? Committed bunch. But more than us, Anuj is Mubarak ko, anniversary, right, Anuj?
Yes, Prashant, thanks so much. It's actually a big day, 28 December.
It is a big day.
Not because, and I'll tell you why, not because it's my anniversary, because it's the birth anniversary of two of India's biggest corporate icons, right? Dhirubhai Ambani and Ratan Tata, who by the way turns 85. So happy birthday to Ratan Tata, and of course we always remember Dhirubhai Ambani. But look, from the market point of view, let's get back to...
No, before that, you should not be here. I mean, it's your anniversary.
Yeah, Prashant said, we are a dedicated bunch. And you
I
know
hope
me,
you're compensating
Sonia,
with some good gift.
This is, I mean, for 20 years, I've never taken the last week off, except once. Otherwise, never. And, whenever the calendar comes, people are always taking, next December off already. So.
But it's always fun to not take the last week off of the year. Why? Because generally bosses are on leave. So but now you're the boss, so you can take leave.
Yeah. But anyway, the volumes are low, and you can. It's tough to actually carry through the show sometimes. But it's okay, we've been doing it for the last 20 years, so I think we can do it again. But anyway, let's talk about the market now. Soft cues, of course, US market fell, and low volume trade though, but one big factor to watch out for is the US 10-year bond yield, because from the lows of 3.4, it's inched back to 3.85. Which means that, there's a fear factor back. Today you will test the texture of the market. Chinese market is doing well though, and that macro Chinese theme is likely to do well once again. I think metals did really well yesterday. Maybe that continues. But interest rate sensitives like Nasdaq, you saw it fell. So IT may again fall today. Mid caps and small caps may underperform. That may happen. As far as the indices go, for the Nifty, the range yesterday's low and high 17,967 to 18,150, and the SGX Nifty is indicating that we open bang in the middle of that range. So when you open in the middle of a range, there's absolutely no trade at the open, and then you wait to see if either of the two boundaries are getting tested, and perhaps you take a reverse trade on that. So maybe around 18,000 a buy trade, 18,000, 167 a sell trade. That's what traders may try. On the Bank Nifty, the support is 42,400 to 42,500. That's where the Bank Nifty turned from yesterday as well. So if 42,400 breaks, the market becomes weak, which is not my base case. My sense is that banks will lead the market recovery, if any, today. And I won't be surprised to see even green at some point on the Bank Nifty, because it's been the stronger index.
Okay, Anuj, thanks a lot for that. Enjoy your evening. For now, the pre-opening rates are actually settling a bit lower, so just keep your eye on the screen. The Nifty, we'll wait for these rates to adjust, but for now, the indication is that about a 60-point downtick is what you can expect on the index. Nifty at 18,000, holding on to it by the skin of its teeth, and the Sensex down 130 points. Let's get some F&O cues out of the way, considering its expiry as well. This week, Chandan Taparia, derivative and technical analyst at Motilal Oswal Financial Services, is with us. Chandan, good morning. A pleasure to have you on the show. Your thoughts on the market, and what are the individual stocks you're looking at?
Good morning, Sonia. Thanks for having me. So we have seen good recovery in the market from recent bottom of 17,777. But market failed to surpass a key barrier of 18,181, just made high near to 18,150 zone. So I think again we are a tussle of bulls and bears, because immediate support is going near to 17,950, 18,018, while hurdle is likely to be at 18,181. So we are likely to be in this broader range, and I believe if declines happen and it manages to hold near 18,018, then I can put support of 17,950 to go for buy on decline stance. So it's likely to be very conditional trade, and being the now year end and the last week of the year, some sort of choppiness could be there, so one need to trade accordingly. But overall, we believe that 17,777, which is the bottom recently, likely to be a firm bottom as of now for the next leg of rally. Right. Now talking about Bank Nifty index, on last trading session, 2 times Bank Nifty has taken support near to 42,400. So if any declines comes, that could act as a support to drive the move towards 43,000. Now looking at stock specific, that is for intraday and also for next couple of days. So first is buy on Asian Paint. This stock is bottomed out with multiple support near to 3,000 marks. In last so many weeks, multiple times it is turning from the same level. So I believe that better risk reward ratio and support based buying could take it higher zone. So one can buy with a stop loss of 1,050, and here we have a target to us 30 to 30 level. Second trading idea, that is buy on LNT, one of the strongest structure in the capital goods. Measured trend is positive. A small decline is being bought. Put writing is being witnessed in the counter. So recommending to buy with a stop loss of 2080, looking for an uptick to us 2200 to 2222. One sell idea, that is sell on ABFRL. This stock is in a weak trend, making lower top, lower bottom. Fell to recover in after the market recovery. Shorts are intact, so expecting downtick by 3 to 5%. One can sell with a stop loss of 294, and here we have a downside target to us 275.
Chandan, thanks a lot for that. Meanwhile, at the bottom of your screen there was a flash, and on your screen there was a tweet coming in from Elon Musk saying that not denying the possibility that Twitter may actually go ahead and consider purchasing Substack. That would be an interesting one to watch out for, Prashant, because everyone's worried about Elon Musk's attention, whether it's going to be on Tesla, and that kind of explains the decline that we saw on Tesla itself. And now he's going ahead and saying that Twitter will go ahead and perhaps buy Substack as well. So how much can a person do?
I mean, yeah, absolutely. And Tesla, by the way, is getting hammered, right?
It is getting hammered, and for the same reason. And the other thing is that, everyone's worried about what Donald Trump would do with policy making on Twitter. Elon Musk is doing with business decisions, etc. on Twitter, just announcing them.
The man's got a big brain, Mangalo. So I mean, he'll figure. And I think Substack will be much smaller kind of.
But it's a rival, right? I mean, it's an online publishing platform.
It's a publishing platform.
So I guess.
Yeah, but
it's like
a block.
It's an ancillary.
Right?
Yeah, it's an ancillary as against just a direct rival.
Okay, all right. Market laser, where we kind of identify trends or turning points or things which are happening in the market which may be useful to you. Yesterday we put out the China reopening. And how two sectors, oil and metals, perhaps should be in focus, because what China reopening does is it steadies prices for both metals, commodities, with China being the largest consumer of most things, and oil as well. Same reason. Now, I'm looking at charts here. Yesterday we just looked at the reason, and the reason only came out the day before evening, so it was fresh. But prices have reacted, and they are now at interesting junctures. So I'm going to put out three charts. Hindalco, Tata Steel, and JSPL. The first one on your screen is Hindalco. Let me just pull this up on my screen as well. Hindalco is now, after yesterday's bounce, at exactly at the trend line, which is falling from the 28th of March 2022. As you can see, it's a clean downward sloping trend line, and these things work. I mean, the first touch point was... of course, I mean, the start was, as I mentioned, the high. Then there was a touch point on the 5th of December, which is earlier this month. Prices corrected because there were fears, remember, especially last week, last fortnight, whether this reopening in China will play out or not. Infections are spiking, etc. So after touching this trend line, it failed. I mean, prices broke down. Made a low, which was day before yesterday. The low was about 447, and from there, from 447, it's bounced to 471. It's kind of knocking up against this downward sloping trend line. So a break of this perhaps brings more gains. Which is the next one? Let's have the next chart, which is JSPL is what we're looking at. Now, this is a simple kind of chart. JSPL, after yesterday's bounce, for all these kind of commodity names, metal names, what you see in the last fag end of the chart is the last 2 weeks where, prices corrected because of what was happening in China, COVID fears, etc. But, the announcement, major announcement for incoming passengers, inbound passengers into China, which we highlighted yesterday, is kind of made it clear that they're on the path to reopening. JSPL is basically back at the highs of April 2022, earlier this year. It's exactly back there. And the last one we are highlighting is Tata Steel, which, there's a downward sloping trend line, which I think is self-explanatory. It starts from August of 2021. There's a touch point around April of 2022. And those levels right now will come in at about 123, 125. But it's basically bounced back above the rising support trend line as well, which was from the low of June of 2022. June 2022, then October 2022, and a break and then a rebound, all within the last 4 sessions or so. So three charts: Hindalco, JSPL, and Tata Steel, all interestingly poised as we start another day. The index yesterday was up about 4% or so. Let's put some of these points to Amit Dikshit, analyst at ICICI Securities. He's joining us right now. Amit, great to have you with us here. Good morning. Thanks very much for your time. I was, of course, we discussed the news yesterday and just the price action from yesterday's session. But what is your sense? Is there more to go? And to your mind, is China the big dominating driver?
Yeah, hi. Good morning, Prashant. Yeah, of course, wherever commodities are concerned, particularly steel, aluminium, China is the main driver and still continues to remain the main driver with 50% production and 50% consumption. Now, coming to the chart movement or the stock price movement itself. Well, if you look at the metals pack, over last 1 month, practically we hadn't done anything. And as far as China reopening is concerned, we have to wait against the COVID infections as well. So while the policy to kind of ease the COVID restrictions and finally reopening is welcome, but at the same time, one has to see it with the prism of the rising infections that might actually pour cold water on the nascent rally. I would like to draw parallels between this kind of stock price movement with December 20, when we exactly saw the similar price movement. By the way, if you look at the global steel prices per se, they have moved up by around 15 to 20% in last 1 month, largely because of iron ore prices moving up. Iron ore prices back to 115, 118 from $90, while coking coal prices have remained robust. Stable, I would say, at around 270. Now, because of global prices moving up, we would have seen the same rub-off in the Indian steel stocks as well, and particularly when the consumption growth is not all too bad, and the fourth quarter we would see good growth. Traditionally, it has been seasonally a good quarter. So, everything bodes well, except for there is one joker in the pack, which is the China's restrictions coming back because of rising COVID infections. That is the only risk that I see, and a significant risk on top of that.
Amit, we'll just come to you in a bit because it's 9:10 and we just want to get some trading calls out of the way. The Nifty has adjusted to a cut of around 50 odd points, so nothing alarming. The Sensex is down about 115 points. Sudarshan, what's the big call at 9:10?
Well, the Nifty is an avoid for the day. ONGC is a buy with a stop at under 142. ONGC.
ONGC, Mitesh, how about you?
I will go with the buy on Jindal Steel. Keep a stop below 564. Look for targets around 600.
Okay, thanks a lot for that. So that's on JSPL, right? A buy over there. But Amit is still with us. Amit, take us through individual stocks then. Metal prices are, of course, at 6-month highs, but do you see a commensurate move in the stocks as well? And what is the recommendation on names like, say, Tata Steel, JSPL?
No, so if you look at, again, I would be discerning over here because rebar prices or longs prices have behaved particularly well in India due to rise in pellet prices after the export duty was removed. And therefore, we have a bias towards long steel players, primarily JSPL and Shyam Metallics. These stocks should do better. As far as the Tata Steel is concerned, well, you will have to keep a very close eye on how European annual contracts are renegotiated. Earlier, when they were renegotiated in the backdrop of HRC, European HRC being at 1100, and now European HRC is at 680 odd. So one has to keep an eye on that. And spreads, well, I would repeat, they are not exactly very, they are, if you compare with them with 8 years average, they are around that level. So not something very earth-shattering. So not very optimistic on the whole pack as such. But yeah, if as far as individual stocks are concerned, Jindal Steel and Power is our topic in the ferrous space. In smaller space, yeah, Shyam Metallics. And in stainless, we have Jindal Stainless as our key pick.
Amit, quickly before we let you go, there was also an opinion that came in yesterday that if China were to open and there would be higher demand, there'll obviously be higher supply as well coming in from China because their production would open as well. So those could be negating factors. Your thoughts on that? And secondly, what is the difference between prices internationally and in India?
I think you mean steel prices. So
yeah.
Steel prices, currently landed cost is like almost, it's at 5% discount, which is not too bad, by the way. So we would see imports abating, and that's a very positive thing. But, one has to always remember in terms of Indian steel prices that this export duty threat will always remain. If prices go above a certain threshold, government might just think of reimposing it. So because it has been done in the past. Now, coming to the China factor, well, of course, the with the consumption going up, production will also go up. And by the way, in case of aluminium, what we have seen recently, that because of power curves, the production has been low. But that has also been negated by the fact that downstream consumption is also low because it's a seasonally low period. In China, interestingly, what happens before Chinese New Year, there is a lot of stockpiling of both iron ore as well as alumina. So therefore, this also supports prices to a certain extent. However, if I look at inventory of steel, well, inventory has definitely risen over last 1 week, and that is not really very, very positive.
Okay, thanks a lot, Amit, for joining in. Chalet Hotels is another stock on our radar. You're watching that, Mangalam?
Yes, hotels usually we watch towards the end of the year, and this one as an initiating coverage coming in from Prabhudas Leeladhar. They have a target price of 455 rupees per share. They say that this is the best place to ride the industry upcycle, primarily because they have strategically located metro-centric hotel portfolio with marquee global brands, etc. as well. They have Westin, they have JW Marriott, etc. And they believe that the revenue would grow at a compounding rate of 19%, while the profits will compound at a 68% growth between FY23 and FY25. So that explains why the stock is up 4% in pre-open.
All right, we have the opening rates coming through in just less than a minute from now. So do keep an eye out, less than a second rather. That's the first tick on the index. It is down about 45 odd points, so down 0.2%. Sensex is down about 160 points. The Bank Nifty is inching lower as well. It's not a very bad start, you'd have to say. Yes, it started in the red, but about 0.3% lower. The mid-caps are absolutely flat. What's putting pressure on the market today is metals. Hindalco, JSW Steel, Tata Steel, all in the red, down about 0.5 to 1%. And you have ONGC that's down 1%. And IT, there's no respite for IT stocks actually. So Infosys, Wipro, HCL Tech, TCS are all down anywhere between 0.5 to 1%. The other pocket that's not looking too good is autos. So Bajaj Auto is down, M&M is in the red as well. A couple of other auto stocks also trending in the red. What's gaining this morning is some of the defensive pharma stocks. So you have Apollo Hospitals, that's up 0.5%. Cipla is in the green. You have DRL, Dr. Reddy's, that's in the green. Divi's Labs as well. And a couple of these names, NTPC is trending higher, 0.5% there. Tata Consumer Products in the green. Coal India is not doing too badly. Titan. So pharma and consumption are holding up. Nestle is up just a tad bit, you'd have to say. But it's a very quiet start to trade, down about 50 points in tandem with what the SGX was suggesting. But the needle is not moving too much, so still within that 18,000 to 18,100 mark. In the broader markets as well, the mid-cap index is absolutely quiet, down just about 0.2%. Mangalam will take us through the big moves there. Adani Group stocks are doing well, actually. Adani Wilmar is a big mover, up about 5 odd percent. What else are you looking at?
Well, the market breadth is firmly in favor of advances right now. 2:1 is the ratio that we're looking at. And a couple of stocks stand out in terms of news. Nirmal Bang met the management of Jubilant Pharma Nova, and that stock is up almost 4 odd percent. Rail Vikas Nigam Limited, RVNL, is locked in the 5% upper circuit as it's won an order from NLOA as a project implementation agency, which is a strategic government project, for a strategic government project. So that stock's doing well. What's standing out actually from the broader markets is Bikaji. For the second day running, it's hit a 5% upper circuit. Yesterday as well closed with a 5% up move, along with Adani Wilmar that you mentioned already. Balrampur Chini entered the F&O band, so is down almost 2 odd percent. We're seeing some weakness in Shriram Finance, Coromandel, as well as a couple of these mid-cap IT names, the likes of Birla Soft, Coforge, and LTI Mindtree as well, the combined entity that is. In the broader markets as well, the theme's pretty clear. We are seeing some purchase in the pharmaceutical names and weakness in the mid-cap IT names. Some profit taking perhaps on a couple of these metal names as well. Nalco is down about 1.5%. Vedanta down by about 1%. The mid-cap index now is actually losing some ground, down about 100 points, which is about 1/3%. But nothing really to worry about so long as the advance decline stays in favor of the advances. Prashant.
It's quiet, right, Mangalam? And quiet is what we want. And no big moves. Yesterday was a steady day, and I think today again, it's a steady kind of start. 2 days of decent pullback, and you get a 40-odd point, slight cut. It's okay. Just a quick thing on advanced decline, which is, again, even the number of stocks which are starting up on my screen are kind of limited. So it's starting to get a little more quieter as we head to the end of the year, last few days. Fact, if you can pull that up, 4% higher. It's got decent volumes. So that is at 306. RVNL, I think we highlighted 4%. BKG is up. It's a recent listing, a month old, maybe 5% higher, 405 on BKG. There is Varun Beverages, which is starting with, it's down a little bit, I think, a flattish kind of start. J&K Bank has been a momentum kind of mover, so J&K Bank is starting a little higher. GIC RE is starting a little higher. GIC RE is up about 3.5%. Morrison Laboratories has been all over the place recently, and that is starting higher as well. Look at Jubilant Pharma, which is up 3%. I think there was a brokerage note as well on Jubilant Pharma, so that's starting about 3% in the green. On the downside, I think we've already highlighted a fair bit. Market breadth, by the way, is converged. I mean, I think advances and declines now almost 1:1 after starting higher in favor of advances, as Mangalam had pointed out. Mazgaon Dock is down 2.5%. So these defense names have been big movers, and Mazgaon is starting about 2.5 lower. Yes Bank is down a little bit. IOB has saw a big rally, big decline, and a big pullback after that, and now it's starting about 3% lower. Balrampur Chini, UCO Bank, Tata Elxsi, some of the other names which we should put up for our viewers.
PSU banks have started falling quite a bit. I mean, if you look at the trajectory, even in the last couple of weeks, there's almost a 10-15% slide that many of these banks have seen. And now this morning, Bank of Maharashtra, IOB, Dhanlakshmi, Union, UCO, the whole lot falling like 9 pins. South Indian Bank, Yes Bank, just brings us to that view yet again of how, this year has been full of trends, short trends, couple of months. If you miss it, then you snooze, you lose kind of a situation.
Wait till the next year. PSU banks are a team, Sonia. I mean, they don't go down alone, right? I mean,
Both PSU banks and sugar, I guess.
Sugar, paper, textiles.
Just a word on Adani Wilmar, because it's been buzzing for the last couple of trading sessions. This morning, there have been multiple block deals. In fact, almost 14 lakh shares amounts to a little over a tenth of the company's equity, worth almost 80 to 90 odd crores have been changing hands. So it's also buzzing on account of a bunch of these large trades.
Is it a block
that have
deal,
taken
Mangalam?
place.
It's a big volumes on Adani Wilmar, right? I mean, for
big
this
volumes
time
and
of the
a
day.
large bunch of block deals as well.
Yeah, okay. All right. We'll put more out on that, but that's coming up with strong gains. 5%, 578 on that. There you go. That's those are the block deals which we are highlighting. 40 points lower, so quite start. 5 minutes into market opening, 6 minutes into market opening. Ashwini Agarwal is with us, founder and partner at Demeter Advisors. Ashwini has been a little cautious the last few appearances on programs. Ashwini, great to have you back. Thanks very much for your time. How are things looking, Ashwini? Still a little cautious as we wrap this up and head into the next year?
It's a very interesting question because, I was just thinking through what to expect from 2023. And I think it's going to be a story of normalization. So by that, what I mean is that there are 3 events that have defined 2022. One is the invasion of Ukraine. Second is China extreme lockdowns. And the third is the tightening cycle globally. And I think that 2023 will be a normalization on all 3 fronts. At least I'm hoping that the war in Eastern Europe will come to an end through mediation and through compromise. That's my hope. And China and the rate policy, I think, will start to normalize. At least the pace of future hikes will stop. So with this backdrop, if you zoom out and think about it, you have to accept that real interest rates in the positive territory do provide retail investors in India a real option to invest in fixed income, as opposed to only equities. That has been the prevailing trend for nearly 5-7 years in India and nearly a decade in the West. And I think that is a very, very powerful, I would say, development that we have to keep an eye on. And that, I think, has a gravitational impact on valuation. So I think I do remain hopeful that normalization will provide some tailwinds, but I do expect that debt, being a real investment opportunity, will also provide some bit of a headwind for valuation expansion. I think that's how I would put it.
Okay. Ashwini, good morning and thanks for joining in. Greetings of the season to you. Everyone's asking the same questions, right? I mean, what's going to be the banking sector of 2023? I mean, banks were the big buys in 2022 and IT was the big sell. You think it's going to be more of the same, or are we going to have new leaders?
I remain positive on the banks because, despite the sell-off that we've seen over the last week or so, I think, it is a sectoral turn in fortunes, which is a multi-year cycle. And I don't think we should be too early to give up on that cycle just yet. Credit growth is looking good, spreads are looking healthy, and credit costs are way below trend. And I don't think the estimates capture everything right now. So I think I would continue to stay positive on the banks. I also think that IT, which has been a terrible trade for 2022, will turn around sometime in 23. That's something that's looking positive. When I started to look at it, I haven't kind of pressed the button yet, but I think valuations and earnings are starting to normalize quite rapidly. Earnings expectations are starting to normalize quite rapidly. So I think sometime in 2023, that will be a trade to watch out for. And I think pharma, which has been quite a dog, honestly, for the last 3 years almost, should see a turnaround as raw material costs normalize, as transportation costs normalize, and as demand patterns normalize in a post-COVID world. I mean, COVID saw an initial surge in demand for medicines, specific medicines, and then there was overstocking, and raw material inflation and so on and so forth. So I'm hoping that normalization, as I spoke about earlier, will be a positive tailwind for pharma stocks. So those, I would say, that's how I think 2023 will play out. But 23 will also be a significant bottom-up investing opportunity. See, I joined the markets in 1992. Between 1994 and 2003, the index more or less went nowhere. But there were a lot of bottom-up investing opportunities, and I think that is the market that we are going to see for 23 and possibly even for 24.
Well, that's usually the case where, there are a lot more opportunities in the bottom-up space, etc. as well. But, you said that debt could be a real investment option in 2023. If one was to allocate some part of their portfolio to debt, how much would that be, rule of thumb? And secondly, if interest rates are likely to rise, debt is likely to give you a lot more returns better returns than equities, then do you think some of these rate sensitives will get affected in terms of returns? I mean, are you looking at real estate space? Are you looking at autos? Are you looking at housing finance companies?
So let's take this one by one. First is debt equity allocation. That totally depends upon every individual's risk appetite and I would say age. Age in the sense that the closer you are to your 50s or 60s, the higher should be the debt proportion. And the younger you are, you should have more equities. I mean, if you are in your 20s or in your 30s, you should probably be 100% equities. I mean, you've got 20 years of earning life ahead of you. Why would you not bet on equities with all your savings? But I think as you get closer to your early 50s, mid 50s, it should be maybe 30% debt, maybe 40% debt, somewhere in that ballpark. That's my personal opinion. Obviously, you have to tweak it for every individual's risk appetite. As rates go up, there will be opportunity to invest in more debt. I would start going up duration right now, probably a little bit, and then maybe 1 or 2 rate hikes are left, but they are well expected. So I don't know whether you're going to see a significant move in the long end of the curve. So probably makes sense to go up duration curve right now. And coming to the rate sensitives, you know what? Autos and real estate are not classic interest rate sensitives in the Indian context because they're determined by demand, they're determined by affordability. Real estate has been on a down cycle for nearly a decade. The upcycle has just begun. My belief is that real estate cycles are very long, multi-year cycles. So I don't think that we should pull the plug on it just yet. I've said several times before that I've had difficulty finding real estate stocks to invest into because each stock comes with its own challenges. But anything that's a play on real estate looks interesting to me, and I wouldn't call a top on that yet. Housing finance companies is a different kettle of fish. because here the banks are competing very aggressively and housing finance companies don't really have the cost of funds advantage that the banks have. So unless, it's a very unique situation, housing finance companies in a rising rate environment, find it challenging to manage their cost of funds. There is, of course, courses for different courses for different horses. So there are some housing finance companies that benefit in a rising rate environment. So that could be an exception.
Courses for horses or horses for courses?
Horses for courses. Sorry.
No, I'm just pulling your leg. Ashwini, this on real estate, right?
Yeah.
So the accepted wisdom is exactly what you said, that cycles are usually long and they last for many years. But the point is that most cycles, economic cycles, are much shorter. Market cycles are becoming shorter and shorter and shorter, right? We all talk about this rotation very quickly from one. So why shouldn't real estate be a victim of that same shortening of the cycle in that sense? Actually, we had a real estate expert from Knight Frank at one of these conferences saying that according to him, the cycle will be about 3 or 4 years long. And we're already in year 2. Your thoughts, Ashwini?
It could be. It could be that instead of a decadal cycle, it could be a 4 or 5 year cycle. But I think the answer is demographics as to why, this cycle should not be as short as, other market cycles is demographics. I mean, look at the number of young people entering the workforce, the nuclearization of families, affordability of real estate. I mean, Bombay is a bad example. Because it's really expensive compared to the median income of, let's say, a 30-year-old or a 35-year-old. But most other cities and towns, I would say, real estate is very, very affordable, looking at long-term past trends in India, and credit availability is much better today than it was 20 years ago. So I would say that demographics is the difference as to why real estate cycles shouldn't be as short as other market cycles. But yeah, it could be a 4 or 5 cycle, who knows, instead of a decadal cycle. We'll have to see how things pan out.
Okay. It's interesting. I mean, you were telling my colleague Mangalam about how when you're in your 20s and your 30s, the best place to be is equities, right? And we generally talk about the here and the now, but if you take a longer sort of a 10, 20-year timeline, you notice that there are outsized gains that you can make, even in individual stocks. I mean, for example, today, of course, it's 28 December, so we're talking a lot about Dhirubhai Ambani's birthday and how Reliance has generated outsized wealth for investors over the past. I mean, it's an annualized return of 20% that Reliance has seen across all its key financial parameters in the last 20 years, and that's quite a bit. So tell us a little bit about whether one should stick to large caps. Is that the place to be now? Or for this year and the next, perhaps you see outsized returns in mid caps. How does one really position themselves portfolio-wise?
Sonia, if you look at the behavior of the small caps this year, obviously it's volatile, but small caps are down significantly, whereas the market is flattish, give or take, right? And when I look at bottom-up opportunities, I find a lot of interesting ideas at reasonable valuations in the small cap space. So my personal view is that at least, for a long-term investor, it should be a mix across the market cap curve. So if you're picking mutual funds, it should be a mix of index funds to play the large caps. It doesn't make sense to buy large cap mutual funds. You might as well buy the index. And then you should have a reasonable exposure to mid cap and small cap funds as well. Small cap funds have a lot of volatility. So that's the problem with it. So if you're watching your NAV on a monthly basis or looking at your portfolio every fortnightly, it's likely to give you some heartaches. But if you look at the long term, and you say, okay, I'm in it for the long haul and I'm going to stay invested for the next 10 years, 15 years. My bet would be that small caps would give you marginally better returns than large caps. The way to look at this is, a bottom to bottom measurement, a market bottom to market bottom measurement, where you look at a small cap index versus a large cap index, or a market top to market top. So across a cycle, when you look at across the cycle, small caps give you a couple of percentage points more than large caps at the index level. And usually funds do much better because here there is a significant information arbitrage. There are a lot of inefficiencies in small caps. So I would say that long-term small caps should give you a better return than large caps.
All right, speaking about big returns, Page Industries has moved to the high point of trade. This morning there was a note coming in from MK which put the target price of the stock to 50,500. I mean, the IPO price for Page Industries was just about 360 odd rupees. So this is another example of long-term wealth creation. Page Industries up at the high point of trade. Ashwini, we haven't spoken about the consumer space in India. You alluded to the demographics, etc. I mean, there is a large swathe of Indians waiting to consume the best of products. I mean, and I'm not talking about the entry-level products where there is some sort of stress, but consumer discretionary, premium, etc. Do you see any opportunities there?
Yeah, I do see some opportunities, but consumer stocks over the last decade have been significantly re-rated, and many of the stocks are very, very expensive. They're expensive, on valuations on a +1 standard deviation basis even today when you look at a 30-year, 40-year history for several of the stocks. So the valuations don't give me comfort. I love the businesses, I love the long-term opportunity, but I don't like the price point. So barring some few exceptions on a bottom-up basis where you might find a bargain, broadly consumer discretionary as well as the consumer staples space remains quite expensive is what my view is.
All right, we will leave it at that. Thanks a lot for joining in, Ashwini. Have a great year ahead.
You too.
Hope the year is filled, more importantly, with peace, health, love. Money always comes last, right? So hope you get everything that you desire this year. And thanks a lot for being a friend and follower of CNBC TV18. Well, that's Demeter Advisors talking about the year to come. But one space that has done exceptionally well this year is banks. So we talk about that. Canara Bank is the stock on our radar. The stock has seen quite a decent run this year, up over 50%. We are joined by LV Prabhakar, the Managing Director and Chief Executive Officer at Canara Bank, to talk about the year to come. Mr. Prabhakar, good morning and greetings of the season to you. Before I talk about the outlook for the new year, I just wanted to, put forth to you a chat we were having with PNB Housing yesterday, where they spoke about how they are hiring a lot of people from Canfin Homes. And I don't know if you had a chance to listen to that chat, but are you seeing a lot of talent shortage, attrition at Canfin Homes, and are you doing anything to address that?
Let me tell you two things about the Canfin Homes. One, sufficient manpower is available in Canfin Homes who are trained, and it's a continuous process that we appoint and engage with the people so that we can take going forward good people who are experienced. And some people will be leaving. It is a part of the business and it is natural. Second point is, as far as Canfin Homes is concerned, now the business is very stable and growing at double-digit growth. And very soon, the MD CEO will be assuming the charge, maybe before this financial year. And he will be from the industry and he will be from the same financial sector. So we have no doubt about the performance of the Canfin Homes, and the attrition which we are seeing is common. It is within the tolerable limit. So
Bakar,
not a worry.
Yeah.
Rather, we want some people to leave.
So that is, what should I pick on first? So new MD, good morning, Prashant here, Mr. Prabhakar.
That's a great way to put it. Right?
Yeah.
You want to go, it's fine. We want you to leave as well.
But how many, so could you tell us a little bit more? What's the excess, as you see it, I mean, manpower at Canfin Homes and I don't know how you think about this. And this attrition is happening at senior management levels, mid-management. Give us a sense.
Oh, I can say that it is very negligible. It is as per the trend. And this is what I know. And I think they are in a very comfortable position with well-experienced people. And the growth they are achieving, their double-digit decent growth, that itself is a testimony for the manpower which is present in that company. And I'm hopeful that company is going to be one of the best companies going forward.
Nothing unusual, right, is what you're telling us in terms of attrition. Got that. Now, this new MD CEO, you already know who it is, right, Mr. Prabhakar? Or it's a shortlist still? Before the end of this financial year?
It is a final stage of finalizing. And I think he will be taking over the charge within this financial year.
So that assures all of us. Just one final question on Canfin Homes before we move on to business. You are not open to selling your stake in Canfin Homes, right? You all own about 30-odd%.
See, let us understand Canara Bank strength. Already my CRR is at 16.51%. And we are making about 2,525 crores NP every quarter. And I am sure going forward, the net profit will be in 5-digit figure per year. 80% of that will be going to my capital. So I am sufficiently capitalized. And in the last 2.5 years, we have raised about 20,000 crores of capital. So suppose I dilute my stake in any of my subsidiaries at this stage, I'm not going to get any benefit. And I see a lot of valuations in my subsidiaries. Going forward, I'll get at least 5 to 6x times what I'm going to get today. So I think board has decided that during the current financial year, we have decided not to dilute any of our stake in any of our subsidiaries.
Take dilution on the cards in any of the subsidiaries in the near future. Got that. I wanted to talk a little bit about the business as well because, you know, Canara Bank and many of your peers have done exceptionally well this year. I mean, it's a year where you have moved from dealing with NPAs back to a very strong loan growth. Tell us about what the year to come will look like. Are you seeing consistent double-digit loan growth? And is it both in corporate as well as in retail? What are the pockets of growth according to you?
I'm of the view that all banks, private and public, they are going to do very well in Q3, Q4 of FY23. Canara Bank will be doing exceptionally well. And as you have seen, on 22nd of this month, we have crossed 20 trillion size of the balance sheet. That is, there is a very good, decent double-digit growth in terms of advances and deposits also, especially retail term deposits. And financial year 23-24, I think it will be a very good year for the financial sector, especially for the banks. And I am more bullish on the public sector banks because balance sheet is very strong. It is future ready. Asset quality is very good. Underwriting standards have improved. Net NPA, gross NPA has been reduced. OP is being increased and provisions are decreasing. I think financial year 23-24 is going to be very rosy for all the banks, especially public sector banks and Canara Bank.
That's good to hear. Specifically for Canara Bank, if you can give us some numbers. There are 2 points, Mr. Prabhakar. One, some point to Canada's relatively weaker liability franchise, and 2, corporate loan book, which should limit yield expansion, margin expansion. Can you give us some targets, what you have in mind? We're already sort of wrapping up this calendar, maybe 3 months more this financial year as well. As you look ahead, what should we expect? Will these 2 factors limit your loan dispersal? What will loan dispersal targets look like? Or you think these are limiting factors to your mind?
First, I will talk about credit, then I will talk about the liability side. Credit, September, you have seen Canara Bank has grown at 20% YoY growth in credit. RAM has grown at 16.4%. Again, we have a principle in Canara Bank that corporate and RAM will be 55-45%. That is, RAM will be 55 and corporate will be 45. So that there will be a well-distributed credit portfolio in the bank. And as far as yields are concerned, our NIM, we are already at a 2.86 quarter-wise, and we are confident that 2.90 will be crossing. And as far as NII is concerned, we are growing at more than 18%. September, we have grown at more than 18%. Going forward, I am confident that the percentage will increase further. So yield and advances, corporate or retail, we are earning a lot. And NII is the testimony. Apart from that NII, non-interest income, another NII, we are very strong in that. We earn about 4,500 crores every quarter. So going forward, as far as the yield and OP is concerned, we are on a very strong footing. Now coming to the liability side. 7th October, I have increased the retail term deposit rate to 7% for general public, 7.5% for the senior citizens. When the market rate was only 6%, 5.8%. In 3 weeks, we have garnered huge amount of retail term deposits under 666 scheme, that is 660 day scheme, and also 1 year, 1.5 years, 5 years. So liability side as of now for coming 2-3 quarters, Canara Bank is very strong, and it can support my credit growth of 20% plus. So the thought of Canara Bank being weak in liability side is, I think, based on the figures, it is wrong. Thank you.
Sir, could you tell us in 3 weeks what is that amount? You said it's there's been huge accretion to deposits because of the hike in deposit rates. Could you tell us how much is coming?
A trillion.
Sorry, you'll have to repeat that, so we missed that.
More than 1 lakh crores under retail term deposits.
In 3 weeks.
Yeah.
Okay, more than 1 lakh crore raised in retail term deposits in 3 weeks. Just wanted to know, with everything looking so hunky-dory, you've guided for 20% plus credit growth with NIMs actually expanding to 2.9%. It was 2.83%, which was a 9-quarter high in the previous quarter as well. The potential risk could come in from asset quality. So could you give us some sense on, the guidance for asset quality? What are your credit cost expectations for the year going forward? And any sort of expectations from recovery coming in from the NCLT assets over the next 12 to 18 months?
Let me talk about the asset quality. We are very conscious about the risk-weighted assets, RWA, which will decide the future of any asset portfolio. Our RWA is just 66%, which is one of the best in the industries. And in corporate portfolio, A and above rated percentage is about 77%. So quality-wise, we are very conscious, and our underwriting standards are very good. So if you see my net NPA, it is 2.19. And we said that in our guidance that very soon we will be less than 2. So asset quality-wise, we are very strong, and going to further also we are going to maintain the same standards. Now coming to the NCLT accounts, I think every quarter we'll be getting about 400 to 500 crores from NCLT, either through resolution or through liquidation. And I think this will continue. And there will not be any major recoveries from NCLT, which will be in a 5-digit figure. So I think I are in 4-digit figure. So it will be around 400 to 500 crores in the coming 1 or 2 quarters. So asset quality is going to be very good for Canara Bank. And the net NPA, we are trying and working hard to see that it is less than 2 and gross is less than 6.
That's great to hear. Asset quality will improve. Coming back to, loan growth and corporate capex, I wanted to check with you, has corporate capex come back in a big way, or is it just the old projects that are getting, refinanced or loans over there? Trying to understand, because we do hear of green shoots, but we know that a lot of it is coming in through, say, government capex, and corporate has not come back in a big way. Your thoughts?
It has come back, but as you say, it is not in a big way. But basically, our loan growth, we are more focused on infrastructure, where again corporates are there, but these are all HAM projects, and we have underwritten more than 40,000 worth of HAM projects. And the second one is we are a bit aggressive in steel, and also we are taking nowadays exposure to commercial real estate also, because we are growing at 17% in housing loans. So naturally, we want to finance commercial real estate residential so that we will get housing loans also. So I think there is good traction as far as corporates are concerned. And green shoe projects, yes, we are getting, but not on a very large scale.
Okay, we will leave it at that, Mr. Prabhakar. Thanks a lot for joining
just
us.
one thing, Mr. Prabhakar, just one thing. You on that stake sale issue, you said nothing in the near term, nothing in this financial year. Is that sorry, go on.
During the current financial year, because board has decided that during the current financial year, we will not be diluting our stake. Next financial year, board may take a different view or same view. That depends on the board.
With the new MD in charge.
Sure.
Yeah. Okay. All right.
It's interesting that we get market guests, etc. They give us stock ideas, but here he's saying that I won't sell it now. I see value of any time between 5 to 6 times on the current assets that we are holding. Only then will we liquidate. So perhaps, is that a message that he's giving to the street as well?
Absolutely. I mean, for Canfin Homes, Canara Bank is seeing great value. Industry professional from the current crop. Of course, I mean, we won't have a name, but will be appointed as MD Canfin Homes before the end of this financial year. Deposit accretion has been very strong, and of course, numbers all are looking very, very good. A very confident-sounding commentary. Thank you very much, Mr. Prabhakar. Appreciate you joining in on the program. Wishing you all the best for the new year from all of us here at CNBC-TV18. Thank you. Well, let's take a quick break here. The market is still down, 14, 15 points. 18,115 is where we are at. We are back with Pramod Patwari of Balrampur Chini. That's the other that's a top sugar name. But it's not just sugar, it's ethanol as well. The distillery segment is what many are very excited about. We'll talk about that with the management of Balrampur. Later, we'll also connect with the management of Gokuldas Exports. The stock is, recently languished a bit. They're big apparel exporters to the US. We'll get a check on how business is doing. Stay tuned. 2 interesting conversations up next.